Good afternoon, everyone. Welcome to Six Figure Portfolio Coaching with Michael Schulman. This is our live trading session on June 3rd, 2014 here at 12 noon Eastern Time. We're glad you could join us. This is Dave Durham. We're going to get started. So, Michael, let's get it.
Ladies and gentlemen, two things. First of all, get this off my chest. My apologies that the session, the alert did not go out this morning. We sent an alert between 11 and 12 saying we were going to do the Fluor and Starbucks trades during this trading session, plus we have another position. Frankly, if you'd been in my house, or my office, excuse me, you would have seen me with my hair on fire. And when you take a look at the charts, you will see what happened to Starbucks and Fluor early in the morning. I haven't had this experience in the context of this coaching program. Frankly, the stocks just ran away, and in terms of the publishing and the getting alerts and putting numbers in place, it was a very difficult situation. Things are much better now. So what I want to do is we're going to go over Fluor and Starbucks, and then we're going to talk about GM and Ford. The trade is going to be General Motors because there was really good news out of the auto industry today. And then we're just going to wrap up, and as a reminder, on the 7 o'clock session. But let's get right to Fluor. I have to change screens here. So bear with me for a couple of seconds. It's wonderful technology when it works. There we go. And take a look at the chart for 2 seconds. And Sumo has just joined us, so if it's barking, it's not one of your fellow members. You can see what happened. This is the one-day chart, and it sold off. Is everybody seeing the chart?
Yes.
It's still selling off, but what I want to do is then, if you can take a look, you can see why I was a little nuts this morning. What I want to do is go to the chains and see how they've changed, and I want to look at the June week ones, and I want to look at the June week 1 75s. We have a 70 to 85 cent premium on something that really doesn't have a great many contracts outstanding, but that's sort of where I want to take a look and where I want to start our discussion today for possible trades. So let me cut over to my version of the position calculator that I create for these sessions, and let me call it up. There we go. And I'm going to change some prices here to reflect what's currently going on with the stock. There hasn't been that much of a change. I did this about 10-15 minutes ago, so the stock price is now 74.71, and the week 1 puts. Actually, all the prices are pretty much the same. What is highlighted in red would be if you were going to instantaneously make a trade. These would be the 2 preferable ones, but this is the end of the coaching program in terms of live trading, and everything comes together. So this is both a coaching moment and a chance to make some real dough. So if you're willing to sell into the money put, the $75 put, short-term trade is a very large premium. Now, because of that annualized return of 50%, this means if you take this trade, you should put a good until canceled order, probably around 25 cents, maybe 30 cents. And even at 30 cents, you're going to have about a 30 to 35% annualized return. And it goes on automatic pilot. And right now, please understand this extreme premium here, the put is only worth intrinsically 29 cents. Where do I get that? $75 minus 74.71. The intrinsic value of the put's only 29 cents. And that, in this case, is where you should set a good until canceled order. If you agree with me, and in terms of sometimes it's really great to have a very solid 30-40% yielding stock with an aggressive options program in your portfolio that's not a famous stock or a high flyer like Apple, then you might do this and say, I'm willing to be put the shares. And if you're put the shares and you sell in June after you're put the shares, so you would do this next Monday. Now I've adjusted the price down here. This is the June price today. I've taken 20 cents off of that and put it over here. And I've added what the premiums are from here to this premium, these two together. This is what you get for selling the put. This is what you get for selling a call, minus some that I took off. And these are the premiums that you collect if you put the shares and then you sell the calls. And this is your annualized return. And I didn't pick these annualized returns because they were the highest. I picked them because I thought they were the best trades. And this assumes, this 50% assumes it's a weekly trade. We do it 50 times a year. This assumes a June expiration of the call, and we're doing it 17 times a year because it takes place in a 3-week time period. Again, let me repeat, I'm not recommending these two because they're the highest amount. I think they're the soundest trades right now to trade Fluor. There'll obviously be room for questions, but I know you want to enter trades, so let's go on to Starbucks, then we'll get on to General Motors. As a coincidence, the two best trades here are also the two highest trades, but let's go to Starbucks and see how that stock is doing right now. Where are we? Option chains. Here we go. Goodbye, Sumo. Sumo didn't like this. He doesn't like Fluor. He doesn't like stocks like that. And so you can see, this is the date, you can see how Starbucks in the first 20 minutes of the day put my hair on fire. I mean, imagine sitting here going, I've got to write, publish, make sure everybody understands things, answer emails in case there's confusion, and these stocks, relatively speaking, it's a few pennies, are really, really moving. But obviously it's stabilized here. It's stabilized around the $74 price point. And the question is, goes back to the fundamentals, would you want to own Starbucks or would you just want to trade it? And that's rather important. So let's go to the chain. And let's take a look at the June week ones, and let's take a look at the puts, and we're at 74.14 as a price. So the 74.50 put is almost 70 cents. The $74 put's between 40 and 45 cents, and they're not very liquid either. With this size audience and your membership and what we're doing, we have the luxury of dealing in options that have lower volume, and the first trading week of the month when you're doing weeklies typically has pretty low volume. So over here, let me go back to the calculator, which I know some of you use. I know that I live and die by it. So this is if you're going to sell a 74.50 or if you're going to sell a 75. And let me explain the logic of these trades. Again, because of the high rates of return, if you sold the 74.50 or you sold the actually this doesn't make sense. Sorry. Much better. Sorry, the 75 has a 95% potential rate of return. I knew there was. Oh, there we go. And you know, that's obviously because of the current price point and so forth and so on. You have to use your own calculators, your own pen and ink to figure this out. I didn't look at the 74.50s and the 74s, which you might think were the logical place in that chain that I just showed you because where the stock is. I went for the 74.50s and the 75s because of my attitude towards the stock and the charts that are supporting that it's going to keep migrating to the 75 price point. It may bounce off of it, but Starbucks is on a run. And it's a great company. It's a fundamentally sound stock. As I said, for disclosure, my children each own 3 shares. I traded in and out of it. I like this trade better, and not just because it's a lower strike. I just think at 75, if you're the kind of person who's forcing yourself to buy in the money put, it's going to make you rather edgy. I'd love to own the shares at $75. If I was personally putting on the trade, which I may after this is all done and you've done your trades, I usually wait, I might sell the 75 and collect the premium. However, the one I'm recommending is something a little bit more conservative because this also gives you the opportunity, to get out. Now, I'm going to now highlight this in blue because we're going to eventually save these as PDFs and you're going to be able to see these on the website. There's a huge amount of extra premium here. This is $1.43 roughly. It's probably within $1.35, $1.50 now. And it's up here at $74.29. So the intrinsic value of this is 70 cents. It means there's 70 cents of value, of premium, of pure speculative premium over here. Excuse me, this is the June. I'm sorry. There's pure, in the June, oh, it was 17. Sorry, I'm going too fast. So there's a lot of speculative premium here in the June. So do you want to do this and put a good until canceled order in, or do you want to do this? And I'm sorry if I got confused in my own spreadsheet, the original one, because it ran away this morning. There were 4 choices. I had 2 Junes and 2 June week ones, and I condensed it because of the way the stock moves. So let me start over a little bit. The June week one is 65-cent premium. There is a modest amount of extra premium here. This is just an absolute play. It's slightly in the money. This would be the position that I'm recommending if you want to do a weekly put that has some risk of you being put the shares or you're having a roll, or this is the position that you should use if you want to set up being put the shares, and if you are put the shares the following Monday, next Monday, I would sell the June. And this is the same calculation as we did in Fluor. You would sell the June 75, and this is your potential annualized return, assuming we did this 17 times a year. Over here is a more conservative trade, although it's a terrific trade, and that's the 75 that has a huge amount of premium, and this expires, roughly in 2.5 weeks. This is a trade where you would put, it's a conservative trade, a good until canceled order, maybe for 15 cents, maybe for 20 cents, and your return comes down to between 20 and 25 cents. But you should reach that within the next week or week and a half, even if the stock doesn't move. You won't have to wait until the Friday of expiration. So I stumbled a little bit in the beginning. Let's recap. This is the recommended trade. It's selling the June week 1 74.50, and you have two choices. Get out, either by watching it or by putting a good until canceled order in. Here I wouldn't put a good until canceled order in more than a dime. A dime will bring down your annualized return to about 35%. If you're willing to be put the shares because you believe in Starbucks the way I do, turn around the following Monday and sell the June 75 call. That means you're neutral on the stock outside of commissions and you're just playing pure premium. This is a stock you can do this for years. As I said in the PowerPoint last night, this is a 3 to 5 year stock. You could do this kind of selling it in the money put, being put shares and selling calls with these potential returns all year long, all week long, because of the liquidity that we see in Starbucks. So those are the two recommended positions. I've highlighted the blue, and I'm going to put this in the PDF as sort of a conservative trade. Let's go to General Motors. There was really great news out of the auto industry. General Motors reported its highest increase in monthly sales ever. Chrysler had its highest sales figure ever. I've been pounding the table about a resurgence in different forms of consumer spending, and I've been pounding the table that American manufacturers have gotten together. I wrote a book, Made in America, which included one of the 4 factories I looked at was the General Motors pickup truck assembly plant in Flint, Michigan. This is all my belief in the company in the auto industry, and I think it has more upside than Ford. Ford's a great company and a very good stock, but I think GM's a great company with a great stock and a higher dividend. And so I looked at General Motors once this news came out. So let's go back and see where it's trading now. It originally, believe it or not, Wall Street traded off on the news, which nothing surprises me anymore. And but the last time I looked, it was at 34.94. Let's see where it is now. Now it's at 34.99. So some of this data may have changed. So let's look at the June week 1s. Let me get my pencil out. The $35 puts are now 50 cents, and the June puts, which is the one I'm going to recommend trading, are June calls, excuse me, that's 55, and that's 83. Yeah, they didn't move. So let's go to the calculator. Let me call up the calculator. Now, before I even speak of the calculator, a lot of you, I get emails, as you might guess, about many positions from Options Income Blueprint members, and this is an OIB stock, as well as from this service, and people go, oh, it's boring, it's not a momentum stock, it's this, that, and the other thing. The premiums on General Motors, regardless of whether you do this trade or not, the premiums on General Motors are very large, considering it's a gigantic industrial company supplying high-end consumer goods. It's very, very, very large. And so the bottom line here is I think this should be a June position. Part of it is coaching. I've just recommended 2 week 1 positions and week 1 positions that are in the money that you might be put the shares. Technically, a $35 put here is in the money, but it really isn't. But the main reason here is you're getting 84 cents.
Michael, can you click your green button?
Oh, I'm sorry. It didn't come through? Sorry.
There you go. Now it's there.
It's there? Okay, it just was slow. My apologies, everybody. The reason I like this is just pure greed in that you're getting paid 84 cents for people's sense of the risk in the stock. That's an awful lot for people to pay on a company like General Motors. It's proof the street has it wrong. It's proof to my point that the stock is strained. And it's just, now you may look at the week 1 put, now this has gone down, I think this was about 45. You may look at the week 135 and going, my God, why wouldn't I sell that? But the bottom line here is I like the June put better from a portfolio balance and a position management point of view. For pure greed, if you think GM is going to continue to run, I think at 35 it will stay there.
Michael, you still need to hit your screen again.
It's not fading. Not showing. Yeah. Sorry. I've done it a couple of times. Did it come up?
There it is.
There it is. Sorry, everybody. So this is the trade I prefer, but I would not ignore this. This is a very aggressive trade, but if you make this, remember you stand some chance of having to roll the position or accepting it. The flip side is here you can place a good until canceled order. Look at this return. You could place a good until canceled order for 20 cents and you're still going to get a 35 to 40% return. If you are put the shares or if you want the shares, and the way I buy General Motors is I sell it in the money put, I collect this extreme premium, and then I turn around and I sell the calls. And this is the trade, which was you sell the week one put because you want to start owning it next week and get the most money out of the June 35 call. And it again, this is the two different positions. So if you are put the shares or if you purposely, remember, if you sell the stock, sell the put now, hoping to be put the shares, you're going to end up with a cost basis of $34.15. The $35 versus the 85 cents, and that's a big discount to $34.99. And then you go around and you can sell a $35 call. So again, it's this. I'm giving you a short-term position, June put, that if you put the shares or opt to select the shares, excuse me, then you have an exit position and a way to make even more money. And this I consider to be sort of the culmination of the different things we've learned. You may have noticed I ignored buy rights on all three, and that's because the rates of return on all three, where the buy rights were considerably below the rates of return on the put position being accepting the shares and selling calls. They weren't as good. They're nice positions, and they'd be great positions if you had a 15% targeted annual return, but they just weren't really acceptable. If you like Ford for whatever reason, I'm going to go back to that screen because we did talk about automakers, and even though it's not a trade I'm recommending, and that's because not because the stock, but because the way the options were behaving this morning. Ford does not have the volatility in its options that GM does. On the other hand, Ford's up 10% in the last few days. And if for some reason you want to experiment and you want to have smallish trades that require less capital, as you can see, Ford's a $16.50 stock. One that I think we started going after either 10 or 11. So if you go to Ford and you look at let's say that we did a buy right on Ford at 16.53, and you sold the June 17s. You see, there's very little there. That's the problem with this, and this is consistent that if you like the automakers, you agree with my logic, and you're choosing between the two. I think there's as much upside. I think Ford is good for 21 or 22 bucks. I think General Motors is good for 44 to 48. That's roughly the same movement in the shares, but GM, the options are just much better. So all things being equal, we want to pick a stock to put in our bullpen and to trade regularly that gives us the premium that we want. So that's pretty much it. I presented you, pardon the pun, some options on options. Now if there are some questions, otherwise, put your trades in. And before we go, I'll give you a little preview into what we're going to be doing on Thursday. Are there any questions?
Why don't you start the preview, Michael, and everybody, if you have questions, you can type in the chat box, and I'll get back to you.
The preview is, we're doing a little bit of a tease, and the tease is I'm hoping that as a proverbial coach, proverbial being with a small p, I don't take myself that seriously, is that everything isn't building up to a pyramid. And the pyramid, you're sitting on the top of the pyramid as an investor who trades. So you're an investor looking to generate cash. Cash may be income, the cash may be to boost the size of your portfolio, but you're standing on the top of the pyramid of both information and potential trading tactics that hopefully you've absorbed, as well as tools that you've absorbed. And what I want to do on Thursday is I want to expand a little bit on LEAP covered call positions. I've been day trading my own account in anticipation of Thursday night more than I normally do. And when I day trade covered calls. And I'm going to review my own positions and my own trades from last Friday, and I'm going to do it today and probably tomorrow. Not last Friday, yesterday, excuse me. Day traded successfully, very successfully yesterday and today. And that's another thing that's relatively new, meaning the cash call trade that we reviewed, invariably we talked about a buy right. And that's one of the reasons there wasn't a hard recommendation for a daily cash call trade. I know many of you have to think about a stock before you get into it, and to summon you to do a trade in 5 minutes, which includes the purchase of shares, I could teach you about it. It didn't seem appropriate when there were other opportunities to make money in a live trading session. But on Thursday, I want to show you in a very concrete way what day trading your own stocks that have calls and that you can sell covered calls, what it can do to boost your return. And I want to also talk about a leap covered call strategy and some things we haven't done but you're ready to do. Well, if you're not ready to do in terms of having done them with experience and so forth and so on, some of the basic tools about managing put and call positions hopefully you got from this program.
Okay.
Any questions?
I think that's it on the questions. So we will actually, Michael, it would be great if you could write these up for people, these 3 trades, since we were.
Yes, I will. I'm going to freshen
it out via email,
and I'll have a PDF to Dave to post on the site within a half hour.
Great. So we'll get back to everybody with email out and posting on the site.
Okay.
All right. Thank you, everyone.
Thank you.
Have a good day.